Greetings, everybody. This is Jeff Scott, and welcome to this week's review. Get my stuff set up here. In 1 second. There we go. It is my pleasure to do this, as usual. This is May 18, 2014. Thanks for all the positive comments people sending, and we'll hopefully keep these going for quite some time. Here's my contact information. I'm also can be reached at hgsidoc@gmail.com. So I called today. I was thinking about the old REO Speedwagon song, Riding the Storm Out. And we're clearly riding out the chop if you're still long. It's hard to make money either way, which has been the sad part, although if you can act quickly and sit by your computer all day, there's been some nice shorting opportunities. But that sort of blew up on Friday, as we'll talk about. Futures are not open yet. It's only about 3:30 on Sunday. They did trade up after hours on Friday for whatever reason. Disclaimer, this is for educational purposes only. Any recommendations in the spirit of education on investment advice? I'm a doctor, not a broker, and I am truly independent, although I do have a strong relationship with the proprietor of HGSI and other programs. I've paid for all the tools that I use, and I say what I want to say. I'm not speaking from anybody's script. People ask me what my strategy is, and my strategy is for you to become your own guru. And that's kind of how I've looked at the market, and I hope that you look at it as well. And to find smart people, whether they're Ian and Ron, Alexander Elder, William O'Neill, Bill Morales, and Chris Katcher, and you could see on this sheet many of the other positive influences that I've had that helped me to create my style, and I urge you to find people that you think are smart and learn from them, whether it's by going to live meetings, as I did this past week with Alexander Elder and Kara Varn, his partner, or it's the Ian meeting, or it's even the meetings that I have here coming up in South Florida. Read, practice, and get software that you can become comfortable with and get good at it. In my case, that's HGSI. I have a lot of different software programs. I purposely hide my desktop to avoid having to discuss it. But what I really need is a real-time platform. I'm sort of more inclined these days to use TradeStation, mostly because their servers are better and the radar station just by far is better than MarketWatch. Thinkorswim is still a great platform, perhaps a little bit less expensive. And then for analysis, I use HGSI and EdgeRater. I do believe in seasonals, and I use a lot of Magenta Trader, and then I also supplement everything with MarketSmith. I always talk about the cyclical nature of stocks and indices, and we've sort of been living in this period of time where every time it looks like this is over, we go through another cycle. So right now, if you look at like the S&P, we're right in the middle. If this is kind of where the bottom is, the low end of this red circle, the top here, and we're just oscillating in there in a trading range. Big down day on Thursday, came back some on Friday, and I'll show you that most of the movement in the week was probably made at the open on Monday, and the rest of the week was just churn. Don't fight the trend, and in an uptrend you want to be long and buy pullbacks. In a clear downtrend you want to be short and sell retracements. In a Darvas box, you want to sell resistance and buy support, and that's kind of where we've been. And we may stay this way for months. We may break to the lower. We may break out above. No one knows, not even the talking heads that say they know on CNBC. We at HGSI land, sorry about that, I sort of screwed up that slide, have used a series of surrogate indexes that help us to understand what's going on in the market. One of them that we use, we got from Ian, is the Canary Index, which looks at a number of leaders from pretty much a year ago, the big guys, Priceline, Apple, Amazon, Google, Tesla, Facebook, LinkedIn, and Netflix. And with the recognition that when they roll over, it's time to be out of the market. And they broke the 50 in March. They have broken the 200 in April. And as we get deeper into May, they're in this, I don't know, it's a descending triangle. if it's a head and shoulders and it's the right shoulder, whatever it is, we keep testing where this dark line is. Our peaks are getting lower and lower. And I think this is typically a bearish formation, but we will break either above this or below it eventually. Right now, we stay in the range, as I said. The LLUR list is a list that we put together in March. Probably is a better list for this current market because it more represented the leaders in the market. And you could see it's fighting to hold the 50-day SMA. So the leaders that we put together at the Palace Buddhist meeting in March are holding up a little bit better, but they're certainly under pressure. Market themes, as I mentioned, much of this week's gains came as the market opened on Monday. The indices are churning in a trading range. Talking heads cause shifting winds. We are still in May, which means continued outflows from the market. Clear-cut winners have been yield, energy, and transports, especially anything that has to do with trains. And then one thing that's pretty clear is it's not just big versus small. It's low beta versus high beta, but it's also value versus growth. On the left, you have the IWM, which represents, sorry about that, which represents growth, Russell 1000 growth. And you can see it's clearly in an uptrend with 17 above the 50, above the 200, and trading above the 50-day moving average. And you can contrast that with the Russell 2000 growth, and you can see that value is outperforming growth. Not that you didn't already know that. My meeting in June is officially sold out. The only people that I'll let in at this point without wait list will be those folks who committed to me that they were paying, and I'm counting them on my list as paid. But at some point, if they don't pay, then I'm going to fill the spot with somebody on the wait list. So if that's you, send me an email that you're still serious about coming. Again, my email is there. The wait list, I can hold a few more people than I've committed already. I really don't want to overdo it from the number of folks there, but we may get some attrition as the month goes through, and I will fill those spots from the wait list. The other thing is I will likely produce a video from this that I'll make available, probably packaged with the indicators, maybe not with the indicators, that I'll make available to the folks who watch my videos, but since others are paying for the attendance, and it will be priced accordingly. This week's ahead, looking at the data, I guess the FOMC minutes on the 21st, which is Wednesday, might be market moving. On Thursday, we'll have some initial claims and continuing claims. And then on Friday, some home sales, leading indicators, natural gas inventories, which has been a market mover, and new home sales, which interestingly, I guess there was some housing starts were higher last week, but they're mostly multifamily. We're starting to get near the end of the last earnings season, which means we're probably getting close to the next earnings season. And you can see these are some of the things on the lower right-hand corner that we might expect earnings to be coming out this week. Hertz, I think, has missed their dates a couple of times and rescheduled. I don't know if this one's a real one. Urban Outfitters is a big one. Staples, TJ Maxx, Home Depot, PKS, this is Dick's Sporting Goods on Tuesday. Wednesday, and you need to know this about your stocks. I don't mind talking about Cena's a big one. Some of the solar stocks. Thursday before the opening, quite a few. Kirkland, Dollar Tree, and after the close, and very few on Friday. So at this point, let's go take a look at the charts and the other things that I have. Let's start by going into TradeStation and taking a look at the elder indicators. And I also thought I'd point something out. There was actually somebody put on the HGSI board a good comment about what happened at 2 o'clock. This is the NASDAQ 100. This is an auto trading platform that I had created for me that I use. It basically looks in the opening day breakouts and other things. But you can see I had a long entry occurring late in the day on Friday. But what really matters is that here's the opening on Friday, and we traded down at the opening, and sometime here, let's see what time that was, 2:54, we crossed positive for the day in that area. I guess maybe it was down here, 2:30-ish, and we had a nice finish for the day. The low of the day was right when the market opened, or it was at 10:30, shook out, I guess, all of us guys, and the market traded up the rest of the day. If one looks instead at the contras, you can see a very similar pattern. Here's the biotech, peaked early in the day in the BIS, which is one that I've been using as a shorting vehicle, intermittently at 10:30, sold off the rest of the day. The VIX peaked at about 10:30, sold off the rest of the day. And TZA, which is small caps, same thing, peaked, but then it went sideways and sold off kind of at that 230, 245 range. So this was a market that did sell off late in the day, or excuse me, did go up on Friday late in the day, and the contras sold off. We'll see if that follows through. And as I mentioned, futures were up Friday after the market closed, before futures ended. I did have the opportunity of spending last weekend with Alexander Elder, learned a lot, great teacher, really appreciated the opportunity. You know, it's funny, he really uses these charts. He has used the high jump, although I did show it to him. So a couple of different things to look at. We'll start with, let's go to major indexes, and let's look at the NASDAQ. And you can see the NASDAQ on a daily chart is red on the daily, it's blue on the weekly, and blue on the monthly. So the NASDAQ is still in a sell signal. This red color is determined by two measurements. One of the measurements is being above the exponential moving average. Let me see here. And so here's when the average exponential moving average at 4109. The NASDAQ closed at 4071, so it's about 38 points below that exponential moving average, so that would be a negative. And the other thing it looks at is the direction of the MACD histogram, which is trending down. Two negatives are going to be a red. One of them is positive, you get a blue bar. Both positive, you get a green. And we know that, let's see where we are here. Let's look at the right day. So the EMA is at 4107. So at 4,095, which is only 5 points up, the MACD histogram will start to go positive, and that will change this to blue. But right now, the NASDAQ's on a sell on the daily. So you could be selling or holding, but you shouldn't be buying the NASDAQ unless something changes. The Dow's totally different, although red on the daily, blue on the weekly, blue on the monthly, and it's actually was a lot stronger. And if we look at on the Dow, where's the crossover going to be? So Dow closed at 16,491, and the crossover, it's got a ways to go to hit the crossover, and the EMA is at 16,504. So the Dow has gone negative, and if we look at the S&P or the ES, we can see that on the daily is red, the weekly is green, the monthly is blue. but you have enough evidence, I would say, that this market is red across the board, which should be enough to make us concerned. Look at the NASDAQ 100. It did turn blue on Friday, and that's perhaps the most optimistic. It had been red. Now, last weekend, 1, 2, 3, 4, 5, we had a Tuesday reversal day a week ago after a nice day on Monday, Wednesday, Thursday, Friday, and then we had a big gap up on Monday. That's where I said most of the money was made. And then the rest of the week was basically selling off from that gap. So we could see that again, but right now these indices look to me like at best they're on a hold to concern about the downside. I like to go into my end of week work to get an idea of what happened last week. And there was a big inversion last week. So last week the S&P 500, this is measuring from an end of day on Friday the 9th to an end of day on Friday the 16th. So it may be different than numbers that you measure if you use a different period. The S&P 500 from close to close was essentially flat for the week. It was down less than 1 point, or less than 0.03%. The HGS 100 was up 0.25%. My stocks are up 0.5%. The IB50 was up 0.75. What was interesting to me is my buy list last week was up 1.14%, and the GIF All-Stars, which is one of the lists that I'll also create today of the best, outperformed everybody at 1.34, and then the high beta list was up over 2%. So there's some very big changes there, and that some of these better performing stocks the last 2 weeks were laggards. So maybe this is why the NASDAQ 100 looks stronger. Maybe this is hopefully going to show us some improvement in strength across the market for the bulls. But that is a reversion where the S&P actually underperformed. Now watch what happens. Let's just look at the IBD 50, the HGS 100. It was up 0.25%. Now if I take it Monday open to Friday close, it was actually down 0.37%. So how could you be up from Friday to Monday and down from Monday to Friday? It's because there was a gap up, and that it went out on Friday, the HGS 100 index, the index number 3064, and it opened up Monday at 3083. And so at 3072, it's above Friday, but it's lower than where it opened Monday. So a lot of things come down about 30, 40 basis points, showing that they opened up compared to where they ended the prior week. And the high beta stocks are still up there on the top. No Hindenburg. Last Hindenburg was December 6th. You can see here, all clear on the Hindi signal. Bucketology, looking at two lists, we're sort of leaning towards the negative side on the buckets with 60% below the midline of their S&P 500, yet still quite a few above it, and a big peak at the 30 percentile. If you look at the high beta stocks, still nearly 80% are below the midline. So even with the improvement last week, high beta stocks clearly underperforming their big brothers. From a market perspective, this is what the churn looks like. Ignore those other three. This is the Woody indicator, the bandwidth times the percent B. Green is go long, red is your short, and yellow is basically churn. Now what stands out to me is that if you look at the length of the previous yellow sections, or yellow and red sections, we are double. So this has been a very long-running period of churn, and maybe just because it's May and I shouldn't be surprised, but this is a long period without any good trending. This is a great trend when it's that red for that many days, and this is a great trend up when it's green. And when it's bouncing between yellows and reds and greens, it's chopped and it's hard to make money, long or short. The George Lee indicators, one of the things that we built into EdgeRater, or Chris built into EdgeRater, is a great tool, whether you're a fan of George Lee or, frankly, if you're a fan of Morales and Hatcher, Here's like, for example, M&K's code red. And what I do is I run these scans in EdgeRater, and I actually try and identify potential shorting candidates by the ones that come to the top, whether they're in the code red or code blue category. Things that we'll be talking a lot about at my September meeting. So we've now looked at a number of different things. Let's jump into HGSI. And I've got the latest add-ons, which hopefully you'll get them loaded up today as well at some point. And I would do in the program is go help, actually go up here, help, add-ons, and then make sure that you're up to date. And the new ones this week really are the Ian Woodward and Ron Brown set. So something that you might want to take a look at. As you see, the futures are up a lot, but this is based on Friday at 5:14, so it really doesn't mean anything right now. So HGSI has changed their user group. Ron did an excellent video today explaining it, so I'm not going to address it very much. Well, what I like to do when I start my analysis, and yes, I'm the master of lists, is go down to the Woodward and Brown user groups, go into Major Markets Plus, top-down view, and take a look at where the strength of the market was. So you could see the ones that were green in the Woody indicator. The transports, as I mentioned, they've been strong. Interestingly, at the same time, so was oil and gas and bonds. What's been weak is the Dow, S&P 100 mid-caps. So an S&P 500 down here, so perhaps we're seeing a little bit of the larger stocks catching up to some of the weakness in the smaller stocks. If you look at a 5-day move, gas and oil led the way. Volatility was down a little bit, and you can see most of the indices are here down on the bottom. So it's been a rough 5 days, even though Friday ended up okay. If I look at the S&P 500, let's take a look at the market itself. So this is a relatively simple view. I guess I'll keep this one up here. I'm looking at the S&P 500, and it's really the 8 in purple, 17 in green, 50 in blue, and 200-day simple moving averages. The 8 is exponential. And we all know that over the last 2 years or so, we've had a huge up move in the S&P 500. And if we make this a little tighter in, I keep talking about, do we go up, do we go down? But one thing I should be talking about and have been talking about, let me clean this up a little bit. We're really in the middle of a trading range here. And I don't think anything looks different than it did last week, except we're still in this middle of chop. And I actually drew it in last week as well. We're at the top of the trading range. We get this vicious shakeout here several weeks ago. What do I expect? I expect us to stay in a trading range, and we're in the top half, which means we might go back up and test the top, or we come back down and we meet here. Hopefully we don't do that and we stay no lower than this area. But bottom line is, we are in a trading range on the S&P 500, and until something changes, my guess is we're going to continue with this churn. If I want to be bullish, I like to be bullish. We're still above that 50-day moving average, and that might be a good place for us to see a bounce. And that would be the bullish part of me. So from a trading range perspective, it would not surprise me to see us come down further. If we pull down to this 200-day and net it up here in about the 1810, boy, would that set up a major rally. Until then, maybe the 50-day holds and we get a couple of good days, or maybe we come down here and test. But right now, we're still in chop land until we take out that high. If I look at the NASDAQ, Big pullback here to the 200, kind of what I talked about us needing to do maybe in the S&P 500. And we end up here also in a bit of a trading range. And, you know, we're sort of in the middle of the trading range on the NASDAQ as well. Feel like a broken record. Take a look at the Dow. Sitting on the 50. Now, the 50 has been relative support over the last couple of pullbacks. So again, maybe we bounce here. Thursday came down and held. Maybe we bounce. That would be nice to see. And then the Russell 2000. The worst looking of the bunch is it's failed at the S&P, excuse me, at the 200-day moving average. Now, when I talk to folks who know a lot more than me, they tell me that it's unusual for the Russell to take the whole market down, that it would be more likely if the market goes up, the Russell will follow. But we're not certain that the market in general wants to go up, are we? Let's go back into my other chart, which is obviously a lot more going on. And so up at the top, I just call these my technicals. I have my bongos, my accumulation distribution, and my force. There's no volume, you don't get a force. Green is good, red is bad. I have my high jump indicator where I'm looking to see how we are compared to previous highs. You can see on the Russell when we took out highs here, in a red candle high, then the peak, and it's sold off ever since. This is my squeeze. This is my local breakdowns and breakouts. Same 8, 1750, and 200-day moving averages. Pocket pivots will be found now down here. These are Eurekas and Phoenixes. These are on the market itself. And it looks like we did have a Eureka on Monday, but no follow-through. Not really going to do anything afterwards. And then kahunas are on the bottom. So the Russell broken below the 200 clearly is weak. A couple of other things to take a look at. Old favorites, gold and silver. Gold is just sort of going sideways. It's got to get above this 50 and the 200 for me to be a believer. You got the PSAR in support. I do believe gold goes higher. I just don't have any clue as to when. I look at silver and it's not as pretty as gold. You can see it's quite a bit below the 200 and the 50. So same old, same old. We live in chop. Maybe we're at a good bounce point, and maybe that's why we closed up on Friday at the end and had the futures go up. If I go down next to industry groups, I see that we now have 196 groups. So we have a number of different groups that we didn't have before, but what they are is broken out things into subgroups, which I think would be much more accurate. If I do the same thing and look at force up, you can see that 58, so about 28, 30% are positive. Very few, if any, are to the downside when you think about the day we had on Friday. Well, Thursday was pretty ugly, so that's interesting. Ranking them by combo, what I typically do is first I want to step back and just take a look and see what do I see here. And what don't I see there? I mentioned REITs were strong, so how many REITs made it in the top 58? Office REITs, lodging index, which are a lot of REITs, specialty REITs, healthcare REITs, industrial REITs, multi-housing REITs, multi-asset REITs, that's 7. Hotel ownership REITs, 8. Retail REITs, 9. So of the 58, 15%, you could actually go into that's not going to help me here. I thought I could go into it doesn't bring the REITs up into a higher group. So lots of REITs, so that tells you something. When I see REITs, I see telecom up at the top, and I see tobacco, I think yield. And that's clearly what's going on here. So let's go through the top 10 or so. Department stores, JCPenney's had some revenue growth for the first 10 ages. It's a stock that's had continuously down same-store sales, and you wonder if it was ever going to stop falling. If you look at this on a weekly, you can see what falling looks like, where it had a peak back here in 2012, and then everything turned red, and it's been just awful ever since. You can see there was a, that's weekly. Here we go. You can see where we are right now. You've had some volume come in. You had a kahuna that broke above the downtrending 200-day moving average. Lobo breakout from the squeeze. A viable gap up. I'm not buying it, and I wouldn't if I was using your money either, but it certainly is a change. And J.C. Penney's does not pay a dividend. It brought other department stores up as well. Here's Nordstrom, big viable gap up. If I wanted to buy one, I'd probably look at this one or Macy's. I still don't know that's what I want. But buying, yield is 1.9%. And then we have Dillard's also had a big gap up. Something clearly has happened here, and it's probably worth some research. I just think I'd be looking elsewhere and not just buying JCPenney's because it's the top on the list. Telecom carriers, I love Verizon right now. Rackspace is currently in play, so a lot of the stuff that we're going to see on Rackspace is probably potential takeout, so I'm not going to look at that. I am going to look at Verizon and say, here's a stock that just broke above the 200s, means it's been in a downtrend, has turned around. Here's the group strength. Everything is green on the weekly. Let's go back to daily. And the reason why I bought some of this is yield of 4.3%, and I don't think Verizon is going anywhere. If we continue in the land of chop, the stock has actually made some ground over the last 3 or 4 months, and it pays a big dividend yield. You had a pocket pivot, you had volume, you had a kahuna, you had a mobile breakout, everything's green above. I like Verizon a lot. AT&T really has led the way. Everything is green. AT&T pays a 5% dividend. So I think these guys are up here. They're good companies, but I think it's a dividend. GoGo is going to have some competition. I don't like the chart much. Next one is Communication Equipment Index. So interesting that Apple's in this one, but I guess they've gone from being a computer maker to a phone. So that probably explains why they're up there on the top. Why am I doing that? So if you're an Appleonian, everything's green. You had a mobile break. You're at 600. Buy, 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 buy. I can't buy Apple here. Maybe this is it, and maybe this is the time it's going to run. Earnings per share growth is slowing. If the best that they can do is go out and buy Beats headphones, and that's what their innovation is, that worries me a lot. That said, blue on the daily, green on the weekly, green on the monthly, it's certainly one that if you want it to be buying, it certainly has the right characteristics. Just not a believer in the story anymore. Cisco used to beat earnings by a penny. They had a big beat, and they got rewarded with a viable gap up on Friday. I think the stock is in a nice place, and I'll continue to watch it. 3% dividend. If you know Morales and Catcher, you know his rules for trading a viable gap up. You're still midway on the gap up day. You could buy this if it opens above that point and put your stop somewhere below, below porosity, but below the low of the gap day. Cisco Systems still looks very good. I don't usually go below the index. I am here because I like Eris. Eris is a stock that I've had off and on. It had just some great earnings that came out this past week, and the stock popped on them. I like the stock for a while too. I think going forward it still has a lot to offer. You can see it's got great earnings per share growth going forward. You'll see it pull back, broke the 50, broke above the 50 here with the viable gap up, retested. I think it wants to run again, and that's Eris Corp. All right, the next group I'm going to look at is going to be infrastructure software. These are things that have been beaten up. I didn't look at them yet. Let's just take a quick look-see. So the reason why I haven't been buying these is that they've been in a downtrend below the 200-day moving average, but they've had about 5 or 6 days of a gain. Here's the 200. Kahuna's multiple days in a row. Some volume came in. Everything is green. I don't like to buy below the 200-day moving average, but it looks like something positive is happening here. Pull back, and maybe it's going to get back into its uptrend. So Semantic looks interesting. FireEye, bottom fishing. Palo Alto also bottom fishing, but at a point that might make sense off of that 200-day moving average. I don't like these too much. Unfortunately, when you get to a bad tape, it's hard to find great looking stocks. I did like Autodesk. I think this popped on earnings. I think that's one thing I'd have to do a little research on. We'll look at that real quickly. But Autodesk had a Bible gap up on Friday. Uptrend, pull back to the 50. Pocket pivot, Kahuna, giant volume, Bible gap up, mobile breakout from the squeeze. I'm guessing that this has to be on earnings, and the answer is rises. Earnings surpass expectation. I think that's an interesting looking stock, and that made it onto my watch list for Monday. Adobe, not nearly as attractive, and Intuit. I like Autodesk here, and if I were, I'm just curious what Workaday is. It's one that got hammered. And Workaday, trying to find a bottom. I'm not a bottom fisher unless there's really special circumstances. Next one down is beverages. Love this one of my favorite charts. One of my companies that I've been in and out of, and probably time to go back in. This is Constellation Brand Stars. It makes money. Nice uptrend. Been sideways for a month or so. Broke above the 50. PSAR reversal, mobile breakup from the squeeze, pocket pivot and a Kahuna, mostly green up above. And I like STZ, Constellation Brands, a lot. I'm a buyer here, no dividend. Coca-Cola, not excited about the company. Kind of had a mobile breakout from above the 200 going sideways. Pass on that one. Must be people drinking beer in the time of despair because Molson looks great. Mobile breakout, pocket pivots, massive volume on Friday, probably earnings driven as well. Next group down, semiconductor services. The second one, a big leader. Taiwan had pulled back here. Been a nice uptrend since. All green here. I don't see any earnings, which bother me. Probably is too late on this one. You can see the high jumps getting up there. But Amcor, I'd rather buy this on a pullback to the 50 if I ever get one. Good earnings per share growth. Another small technology, less than a $10 stock. We'll be back in technology in a second. Midstream oil and gas, all over my list of great companies, are great plays right now. And what's driving these are dividends. ETE, lower left, upper right, beautiful chart, 2.8% dividend. Everything is green here. You see the group strength is leading, pocket pivots and volume on Friday. Williams companies, all green, big move up, multiple pocket pivots. Kinder Morgan, go back one. Williams Company pays a 3.5% dividend. Kinder Morgan pays a 5% dividend. And the stock's been in a downtrend, but you see the group, and this thing wants to go higher as well. A lot of Kinder Morgan. Any of the other ones stand out when I look through it? This is New Star, another nice lower left, upper right, sitting in a bit of a squeeze, had a PSAR reversal, great earnings per share growth, and a 7.4% dividend, which is why I remember that one. And MMP has been a big runner as well. So you might be wanting to be playing one of those. And more. Applied Materials, what a beautiful looking chart in the semiconductor capital. You can see a pullback, and then on earnings, all of my favorite things turn green. Bible gap up, Noble breakup from a squeeze, pocket pivot, volume, and a kahuna. This is another chart stock that's high on my list. Dividend yield 2%. I like this one a lot. Another nice player here is LRCX, Lam Research, trending up, but I like Applied Materials much more. So we're actually finding stocks that are viable. And going back to the close story, this is Gap. You can see several of these familiar names. Doesn't look like much, except when you look at the weekly. Is it ready to break above the 50 and move? We had mobile breakout from the squeeze. It looks interesting. So I'm going to pay attention. I'm going to pay attention to Gap this week. My wife is screaming in the background, so I hope you don't listen have to hear her. Those that are coming here will realize she's a wonderful person. We'll get to meet her soon, but I think somebody's hard of hearing on the phone. All right, she's FaceTiming. All right, I'm going to go close my door. I think my wife, who's technically technology challenged, it's probably the first time she's ever FaceTimed. That's why she's screaming. Looking on the list, I mentioned rails. The railroads look good. The railroad manufacturers, Pinity, continues to be a huge leader. I don't know anything about healthcare REITs. Here's what I do know. I know that Obamacare's increased utilization hasn't cut back any payments. I know that there'll be need for more healthcare professionals. I know that a lot of people are building buildings, practices. I know that my practice, which was the sole tenant of buildings that my partner and I own, sold those buildings to a REIT. So you have long-term relationships with the people that you bought them from. And physicians have never faced a recession, so they're unlikely to go out of business. So maybe these REITs are gobbling up, and that's why they're doing well. Well, they came off a low here. This is HCN. I don't know what to do with earnings per share growth, so all I know is big uptrend, pays a dividend of 4.9%. Here is Ventas, BTR, a little bit of a pullback here, dividend 4.3%. Here's HCP, 5.1%. The charts look the same on all of them. I'm not even talking. OHI, 5.5%. HTA, 4.6%. MPW, 7.9%. HR, 4.8%. And Sabra, 5.3%. I can't say I know anything about REITs. I know that with the interest rates being low, let's see if I can do something on that. This is what you should never do when you do a program, which is go ad hoc and see if you can figure something out. But the interest rates are low. It's got to support the REITs. And that's why tobacco looks good. The REITs look good. Utilities continue to look good. I'm just going to take a look at a couple of the internals that I've looked at before to see if they give me a clue as to is this market ready to flip and go positive. It was a nice day on Friday, but it was a nice day on Monday and a cruddy day on Thursday. So it's been very difficult to get excited about market direction for me. I may not be able to get this to work. So I wanted to look at percentage of stocks above the 40-day, and I need to look at this with a different type of a chart. And see if I can figure this out. Oh, that's probably a mistake to do something on the run, but let me just pull this up. Blank chart. All right, let's make this into a bar. And I guess I'll leave that. Let's change this into a daily. Okay, that's what I wanted to show you. And then let me overlay the S&P 500. So what I wanted to show you was that I drew this line before, that when the number of stocks trading below the 50-day, in this case the 40-day moving average, drops down to this line, it's typically when the stocks market turns around. So we're not close to that. We could look at the McClellan, let's see if I can find it here. And here's the summation index. And, you know, it's these lows. Now, perhaps we are, I hardly ever use this product, so all right, I'm going to probably bounce out of this. But what I just wanted to show, here it is. Horizontal, vertical. We are down to this point here, if this is a trend line that's fair to right, where pullbacks in the McClellan oscillator to this trend line have been reversals in the market, so we might be close there. Let's look at all right, so I'm not seeing what I want to show you. But basically, the point of this was when I went in that first chart is that we're not down to the point that we always get reversals. I don't think we're at enough pain right now that that we're going to get our reversal yet, but we can hope. All right, so that's top-down investing. I identified a number of things that look good. Let's do a couple more things before I say goodbye. Shortcuts. My universe is $2, $2.50, and $1.50, so I always leave that up when I start to play. So one shortcut I might want to do is a group inclusion report. So I'll go File. So I've got to go into Designer. And this is the best of the best report, trying to find which stocks make it in a lot of positive groups. All right. So we're going to go Tools, Group Inclusion Report. And we're going to find 10 stocks that we can look at real quick here. Top 10. 5.18.14. Okay. So what I like to do is I like to go in and pick my favorite smart groups. So here's the smart groups. So under Gallardi, I like sprinters. Under Woodward and Brown, I like a lot. I like best criteria, best of, best minus 15, those in demand, ERG, growth, HGS 100 leaders, FLEPs, shadow stocks, stocks and groups to the upside, strong EPS. Under my name, I like break out from a squeeze, pull back to 50. Under Morales and Catcher, I like Bible gap ups. I like pocket pivots. So now I'm going to have the program go into each of these groups, tabulate what stocks are there, and find me the 10 stocks that make it into the highest number of those groups. I'm going to hit OK. It's going to ask me if I want to go web. OK. Then it's going to ask me if I want to create an index, and I'm going to say no. This is definitely one of the coolest things of the program. No index. So these are the stocks. Oops, here they go. Gentherm Auto Parts, Energy Transfer Equity, Magellan Midstream, Constellation Brands. I mentioned Trinity. We'll look at China Plastics. Targa is another midstream, I think, an oil producer. Here's a REIT. Here's a small oil. And here's the internet retailer VIPS. So these are all great stocks as we're going to look at. So we go now into our user groups, and we'll find one that says Top 10 GIF 518 because I told it to do that. Let's just take a quick look at these. So this is a quick maneuver to find some of the best stocks in the market. So this is a, I think, not real widely traded. It's got trades 276,000 shares a day. It's run from 3 up to 8, so it's had a big move. This has been a shadow stock that Ron pointed out. Good time to buy it on the 17th. Clearly, it's the high jump and extended. Nice run up, probably too late. Here's Stars, Constellation Brands. You already know what I think. Buy, buy, buy. Nice chart, nice time. Here's one of those midstream, big dividend payers. Oh, it's only 2.8%. Gentherm had popped on earnings back here and going sideways since. Great earnings per share growth. I think they make cooling car seats. No dividend. This has been a leader when I've been watching. Host Marriott will fall into the REIT category, and it pays a 2.6% dividend. You can see everything's turned green. It had a mobile breakout from the squeeze and a kahuna on good volume. Magellan Midstream, another one of these dividend payers. We looked at this one, 3.1%. Targa Resources is a refiner, natural gas transmission, so it's in that same segment. And you could see great earnings per share growth and pays a 2.3% dividend, lower left, upper right, clearly a leader. Triangle Petroleum is one of these small oil producers. And here's Trinity. I mentioned the trades. We'll look at VIPS for a second. VIPS has had some great earnings here. Pulled back. Earnings came out this past week, which were also pretty strong. We'll see if it gets it back on the right track. I think people are just afraid of Chinese names and volatility and high beta stocks right now, because if you look at it, what you see is great fundamentals. Technicals don't look bad. Mongo red weekly just because of the pullback. You see the group, which is bothersome. Here is the earnings with the kahuna, the Bible gap up, and a mobile breakout from the squeeze. I mentioned Trinity. The other one you might want to look at in the group, I don't think its earnings are out yet. They probably are. You have to check. It's Greenbrier. The chart looks exactly the same. It's a little bit cheaper stock. These make the trains, and one thing that we're hearing about the fractors is that they don't want to use old train cars because of the higher risk of having leaks and explosions, so that's boondoggle for these guys. Other things that I might want to do as an investor is I might develop my favorite views. We'll work on that at my meeting. So one thing I might want to look at is sprinters. And I don't need to look too far because we've seen most of these already. But let's just go through the top 10 of the sprinters. This is something, I'm going to go with the standard sprinters. So I'm going to go up into David Ghilardi's sprinters. And these would be his top stocks. So you notice a couple things about sprinters. Mostly green on the bongos, mostly green on the force. High ERG stocks, just 2 that aren't green, mostly green on EPS, relative strength, and group break. And many of these are stocks we've already talked about. So very quickly, let's go through 10. ETE, we've already looked at it. New Jersey Resources, this is a utility that pays a 3.2% dividend. Here's Omega Healthcare. This is one of, I pointed out back here when I was looking at it, it had a 6.1% dividend yield. Now it's 5.5 as the price has gone up. Here's that strong technology move in Amcor, which we already talked about. Here is Trinity, which we just talked about. Here is a tanker. Don't know anything about this, but a lot of these tankers, here's a midstream oil and gas pipeline. So it's not a tanker. Oil Tanking Partners is a pipeline. It pays a dividend of 2%. So you notice that we're fine. Here's that. This was I didn't get to this when it was below Taiwan and applied materials, but here's a semiconductor manufacturing, 2 kahunas at the end of the week, and a mobile breakup from squeeze on Thursday. That actually looks quite interesting. So that was 1, 2, 3, 4, 5, 6, here's 7. Target we already looked at, which is number 8. Post Marriott we already looked at as number 9. And Reynolds American is a tobacco company, pays a 4.7% dividend. As a cancer doc, I just can't buy tobacco stocks. So we get the same stocks every time we look at, whether we go top down, bottoms up. The top down as I started, bottoms up with sprinters, bottoms up with the group inclusion report. What else do I like to do? Well, I like to go into my own. And I like to go and actually let's go into all securities. So put this on my filter of scorecard 2.5 and 150. And I'm going to go up into the smart groups. The smart groups are pre-run scans. And I'm going to look at my favorite one, which is pull back to the 50 with the kahuna. And let me see if any of these in the top 10 are potential viable. Since they're pulling back to the 50, I can guess that they're probably not extended. Well, here it is. How many times am I going to have to say STZ, STZ, Constellation Brands. Public Storage is a REIT, pays 3.2%, sitting on its 50. Why do I like to buy these? Because I don't got to go much more than $2 or $3 below the 50 for a good place to put my stop. The hope is that this will continue to be on a closing basis at least support. Here's another REIT in the hotel land, pays 2.6%, going sideways. Looks like it wants to take off. Macy's, we looked at department stores, pull back to the 50, has a kahuna, mobile breakup from the squeeze. Like I said, if I was going to buy one, this is probably the one I'm going to buy. It's not extended yet. Here's another REIT on the retail side. Tangiers pays a dividend of 2.7%. Wabco Holdings, auto parts. So Gentherm was one. Here's another auto part sitting on the 50 with the kahuna. I'd like to see it take out the PSAR. Henry Schein, distribution of dental supplies, sitting below the 50, I'd probably pass. LA Time Fitness, I wonder if this is a REIT. Doesn't pay a dividend, kind of sideways, I'd probably pass. Genesee, Wyoming is a railroad. So I use that smart group. I might use the smart group breakout from the squeeze. So these are pre-planned, done for you. And again, we get the top stocks. Here's Union Pacific, the strongest of the railroads. All green, mobile breakout from the squeeze after a slight pullback. Pocket pivot, volume at a kahuna. Would you like to be in this puppy for the last 6 months? 2% dividend. Here's Constellation Brands again. Here's Target Resources again. Here's Gentherm again. Here's Omega Healthcare again. Here's another lodging trust. This one pays 3.2%. Activist is one of my favorite stocks. I just don't know when to get back into it. Setting up perhaps a nice little shallow base here. Mobile breakup from the squeeze. I put this on my pullback, waiting for a signal. Kahuna, pocket pivot, Bible gap up, I'll fly back in. The point of my last maneuvers is whether I go to my favorite screens from the smart groups, whether I go to Ron's and I look at his shadow stocks. Actually, let's do it the right way. Let's look at his shadow stocks. And I try and take a look at the top 10 in each of these lists. And I see one we haven't seen yet that I like a lot. And I try and find stocks that meet my stuff. Here's that Chinese plastic company again. Supermicro, they had a couple of upgrades, great earnings per share. I guess they're going to start to do servers in the 86 world, which is the PC world, Intel processing world. Kahuna, pocket pivot, volume, took out the 17-day. Mobile breakout, turning green. This is on my watch list. That's what I have to look at. Good earnings per share growth. We looked at TSM already. Here's Finish Line. Pulled back a little bit. It's got earnings on Friday, so I skipped it. Post Marriott, we looked at this as a REIT. AFOP, I never know what to do with the stock. I'm currently in the stock. Pull back hard on a weekly, and I don't know if it's setting up to run again. This was one that went in my indecision pile. It's squeezing here. It's got some bottoming tails. Maybe it's looking for another leg up. Here's a real another REIT, and you can see 4.4%. Everything turned green. Live Nation. If you like Bruce Springsteen, look up Live Nation Entertainment, Springsteen downloads, and they've got all the concerts since the beginning of this tour in South Africa. They're outstandingly recorded. I like the sound more than I like the company. Zale is a jeweler that's in a buyout mode. So I've shown you a number of different things that I do. Let me look at my buy list and see if there's anything that I thought looked interesting that I haven't covered, and then I'm going to say good night. Most of these are names we've already talked about. A couple of wild cards. If somebody reads this and can explain to me why I don't want to buy this one, please do soon, because I'm tempted. CYS Investments, I think they buy mortgage-backed securities, pass-through securities, which are guaranteed by Fannie Mae. It's a REIT. Why do I like this? Because I'm retired now. I like yield. I'm just kidding. I like growth, and I like yield if I can get growth. So I got a stock that has really come down hard. It looks to me like it's put in the bottom. It just broke above the 50. I have a target of $12. It may take forever to get there. But you know what? I can wait forever because it has a 14.4% dividend. So I know there's a reason why I don't want to buy this. Please, somebody tell me why. Email me, because there's got to be a reason. Not loving silver right now, but I love this chart. It's interesting with how bad SLV is. If silver turns, then this is going to be a leader. Stillwater SWC, sideways consolidation, hit a mobile breakup from the squeeze of pocket pivot, Kahuna volume on Friday. Looks interesting. Bunch of those REITs are here. I guess we're at a point now where I've talked. If I have a technology name that looks good, that's perhaps going to good buy point. RFMD, which is buying Triplint Semiconductor, which caused this gap up, has great earnings per share growth. Pull back a little bit, might be giving you an opportunity to get in. So, to sum up what I think I've learned today. The market is still in chop. And as long as the market's in chop, I have to play small ball. And small ball to me means I'm going to take smaller positions. I have less positions than I normally have in the market right now. I am very defensive. That said, I got a filter. I found a lot of charts that look interesting, especially Constellation Brands, watching it blow up after I talked about it this much. We are on the 50 on a number of indices, including the S&P 500. So the question is, if I go back in time, it's been a great place to buy off the 50. Is it a great place to buy off the 50 again? Or are we going to come down to the 200? This is good. This is bad. And so which one is going to win? Is the Russell going to catch back up, or is the S&P going to come down to the Russell? Until that happens, until we have a determination, we're range bound, play it carefully. I identified a number of leading industries and sectors. I think I pointed out a number of stocks that are performing well. As I mentioned 42 times, yield looks great, and I'm going to go back, which is dangerous, and I'll end on this one chart. Why does yield look so good? But what? Because of this chart I'm going to show you. We're looking at yields. And this 2518 is 2.5%. Now, we are range bound now, really between about 2.5% and 3%. If you want to see a reason why the market might rally here is every time we pull back on the green, which is my yield, to this line, the market rallies. So rising yields here may cause the market to go up, but they may cause our dividend payers to pull back. On that note, it's always a pleasure to do these. I do these for me, and I include you because I want to. But I do them for me because it's what I do anyways as I prepare. Y'all have a great week trading. I'll post this shortly. Good night, everybody.